This is part 3 of the PQ problem, and in this part what we're going to do is actually calculate the contribution margin, the actual contribution margin for each one of the products. Now this is a little bit different. This is where theory of constraints takes a significant deviation from standard accounting. Again, there's a couple of different kinds of accounting. You've got financial accounting, managerial accounting, tax accounting, and there could be several different versions of tax accounting, even managerial. Different departments or different divisions could do their own types of thing. The one that's standard is financial accounting, at least relatively standard. That's governed by some standards that are set by the Financial Accounting Standards Board. The rest of them, accounting, the taxation is set by the governmental agencies that are doing the taxing, but the managerial accounting is up to you. It's how you or your organization chooses to do this. So financial accounting, yes, that's locked in. Tax accounting, that's locked in. But this one has some flexibility to it, and I would suggest you look at doing this approach to calculation of contribution margin. There was a simulation done a few years ago. The person doing the simulation ran 7,000 simulations, so 7,000 scenarios using 4 different kinds of accounting, and in every single instance he has found that theory of constraints accounting always produced the most profitable product mix. So it does make a difference how you account for what you're doing. What we're going to do here, I've actually hidden a couple of rows here just so that we can see what we're doing a little better, and we're going to take a look at calculating the different contribution margins by product. So if you'll recall the selling price of these different items, let's come over here and we'll pick up that selling price of product alpha, and then we'll pick up the selling price of product beta, and then we'll pick up the selling price of product omega. And here's where the difference comes in. So with theory of constraints, we do not do anything with direct labor, indirect labor, overhead, those kinds of things. They are called period cost. So they've actually been captured. They're not disregarded, but they've been captured up here in this $6,000 per week operating expense. So that's going to include direct labor, the president's salary, insurance, the rent. All of those things in the short term are going to be able to be considered relatively flat or the same period after period. So that's why we're going to consider those period costs. So in this case, all we're going to do is remove what we absolutely know for a fact to be the cost of the product, raw materials. And for product alpha, we have $5 and $20 because it takes raw material 2 and 1 to make a product alpha. The raw materials for product beta are going to be $5 and $13. And the raw materials for product omega is going to be $13 and $12. Alright. Now for product alpha, we also had a purchased part, if you'll recall. So we need to make sure we capture that, because that's a certainty that we know without question that it's going to take $5 of this purchased part for each one of the product alphas we produce. So what we're going to do then is just take the selling price and we're going to subtract the cost of materials. Okay? And then I can copy that formula across. Okay. Now, if you recall, I've hidden these rows here, so I'm going to unhide them now. And I'm going to use that information for the next calculation. So what I'm going to do right now is calculate the contribution margin per constraint minute. Alright, so here what I'm going to do is take my contribution margin. I'm just going to carry that number down here. And so I've got those numbers. I'm going to hide these so I can see things a little better. Okay. Come up here and grab some numbers for a second. Alright, so my constraint minutes. Now remember what my constraint was? It was work center B, right? So I'm going to grab any B's for the products. And I've already got the address up here. So I'm going to make sure I capture all those addresses down here. So that's going to be here. And then there's only the one B in that scenario for an alpha. For beta, there are two B's. Okay? And for omega, there are none. So now what we need to do is actually do the calculation of contribution margin per constraint minute. Okay, so that's a fairly easy calculation. It's the contribution margin divided by the constraint minutes per unit. And whoops, what happened there? Well, this is not an unusual situation at all. There's no time at the constraint required to make a product omega. None. So that's called a free good. It does not take constraint time. So in a situation where we have an internal constraint, that product is not going to require us to use time at the constraint. Therefore, we're going to make as much of that as the market will bear, as long as we're making the profitable products over here. Okay? So of these two products, we're going to rank them by constraint or contribution margin per constraint minute. So in fact, this is number 1, omega is 1, alpha is 2, and beta is 3.